Keppel DC recently released its first half 2024 results, and on surface, things look quite stable. Gross revenue, net property income, distributable income, and DPU all increased as compared to second half 2023. On a year-on-year comparison, distributable income and DPU decreased due to the rental default of the Guangdong data center tenant. From an interest rate perspective, finance costs also did not increase much as compared to second half 2023. This means that Keppel DC's cost of debt has more or less stabilized. The recent acquisition of the Tokyo data center, the risk average debt cost also decreased due to cheaper Japanese yen loans. With rate cuts expected to come in also distant future, it will already provide upside relief to Keppel DC REIT's DPU, along with the fact that Keppel DC REIT has no debt to refinance till FY 2025. So despite the rather rosy scenario of Keppel DC REIT, why am I slightly concerned by its first half 2024 results? Well, it's all the misleading figures and it's my own assessment of Keppel DC REIT's near-term prospects. Now when it comes to Keppel DC REIT first half 2024 figures, investors should note that it includes one-off item and some interesting accounting practices. With regards to gross revenue for first half 2024, it includes a settlement sum of 13.3 million arising out of the conclusion of the dispute with DSC Technology. It also includes about 10.5 million in straight-line rental income from distressed Guangdong data center assets. Now don't ask me why, but Keppel DC is a funny practice of including defaulted rental income and gross revenue, and then accounting for loss allowances and property expenses. So after excluding these two items, Keppel DC's first half 2024 results only performed marginally better than its second half 2023 results, and on a year-on-year comparison, things look much more worse than before. With that said, the recently concluded acquisition of the Tokyo data center and future coupon contributions from the EUDC note with regards to the divestment of the Intelligence Campus, there should be further upside to DPU for Q3 and Q4 of 2024. However, if we set this value to a peak growth of Keppel DC's first half 2024 figures actually mirrors the growth trend of its gross revenue and net property income since FY 2021. And that's exactly where our main concerns of Keppel DC REIT are, or more specifically, the growth prospects of some of its colocation data center assets. Now, it's no secret that a significant chunk of Keppel DC REIT's earnings come from colocation data center assets. As of first half 2024, revenue from colocation data centers accounted for 63.9% of total revenue and 66.3% of net property income. On a full year basis, colocation data centers contributed to 59.9% and 61.6% of total revenue in FY 2023 and FY 2022. For net property income contribution of 59.7% and 58.9% respectively. Now, given the significance of this colocation data center segment, it is quite worrying to see a negative growth trend over the years. While the multitude of reasons for this declining trend, such as negative FX impact and the previous dispute with DSC Technology, I speculate that some of the reasons could also be due to the declining attractiveness of Keppel DC REIT's colocation data center assets in Singapore. If you look at Keppel DC REIT's current colocation data center assets, more than half of it are located in Singapore. While Singapore remains an attractive location for data centers, Malaysia, or more specifically Johor, is fast becoming a direct competitor, with major companies opting to set up their data centers there. As Keppel DC REIT passed on a bulk of utility costs to its tenants for its colocation data center assets, potential or even current tenants might turn to Johor instead, as land, water, and electricity costs are cheaper there. While there might be lesser connectivity in terms of business and also networking aspects, the future completion of Johor-Singapore RTS and the establishment of a special economic zone will alleviate some of these connectivity pains. Furthermore, with Singapore expected to run an additional 300 MW of data center capacity over the next few years, this will not be sufficient for cloud and hyperscaler players. Thus, due to these factors, I feel that Keppel DC REIT Singapore colocation data center assets would become less attractive over time. In fact, if you consider occupancy rates, there might already be evidence that this is slowly panning out. The occupancy rate for first half 2024 came in at 97.5% as compared to 98.5% the year before. While overall 1% drop may not seem much, Keppel DC is in fact losing tenants and its Singapore colocation data center assets. The overall number of clients and the weighted average lease expiry has declined as compared to the year before. This is a double whammy for Keppel DC REIT. It is not only having fewer current tenants, but also that these current tenants on relatively shorter leases. Whether this is the start of a prolonged negative trend will be highly dependent on lease renewals for 2024 and 2025. Now, part of the reason for this decline of occupancy rate could be due to two factors. Number one, the current available lettable area is too small for the requirements of bigger players. And number two, the current market rental rate is too prohibitive for smaller companies. Nevertheless, it should mention that the valuations of these Singapore assets have risen over the years. This means that by market standard, these properties remain attractive, and the Keppel DC REIT can negotiate for higher rents during lease renewals. This partially explains why in first half 2024, Keppel DC was able to achieve a 40% rental reversion with one of the major clients, likely to be Amazon Web Services. Also, during its most recent AGM, its CEO also mentioned that rental reversions remain on an upward trend, with 38.4% of rental income from colocation leases up for renewal in 2024 and 2025. I sure hope this positive rental reversion trend continues. So Keppel DC REIT experiencing dwindling growth over the past few years. The question to ask is, can it return to a high single-digit growth rate annually? Personally, I think it's possible, but it'll take a few years to materialize. With Keppel DC REIT's current aggregate leverage at 39.2% following the acquisition of the Tokyo data center, it's already literally its internal cap of 40%. Thus, for Keppel DC REIT to continue growing is to divest older data center assets and acquire newer ones. The other way to grow is to do equity fundraising, but given the current market conditions and sentiment, I doubt that Keppel DC REIT management team will go for this option. Organic growth could also come from Kwantong DC 1 and 2, as the recovery roadmap is still being worked on, and the possibility of managing these assets as co-location data center assets are also on the cards. Keppel DC also still retains the right to terminate the purchase of Kwantong Data Center 3. The CEO also mentioned in the AGM that if Kwantong Data Center 3 were divested at current distressed prices, it should still sufficiently cover for Keppel DC REIT's initial deposit of RMB 100 million. Nonetheless, any positive development of the Kwantong data centers will likely take a few years to materialize. Thus, the best avenue of growth will still be for Keppel DC REIT to do asset recycling. So with that said, is it time for Keppel DC REIT to divest some of the Singapore assets? If you look at the first half 2024 results, Keppel DC REIT derives about 55.9% of gross revenue from Singapore. On a full year basis, this figure will be 51.5% and 53.2% for FY 2023 and FY 2022 respectively. While there are benefits for Singapore concentration, such as a strong currency and no FX risk, I think Keppel DC REIT will do well to divest older Singapore assets. Besides the previously highlighted challenges of the Singapore data center market, the government has also mandated all new data centers to have power usage effectiveness of 1.3 or less. For current data centers, they're also expected to have a PUE of 1.3 or less over the next 10 years. While Keppel DC REIT does not disclose the PUE of data center assets due to confidentiality reasons, I speculate that Keppel DC 1 and 2 might not hit the PUE threshold, as they've been Keppel DC REIT's portfolio since IPO 2014. The last major retrofit for these two properties was in 2013 and 2010 respectively. Thus, instead of spending potentially expensive capex on these two properties, Keppel DC will perhaps divest them and acquire newer local or overseas properties. These properties could either be from the pipeline acquisitions for a sponsor or for other opportunities in the market. Regardless of options taken, something has to be done to address the clopid growth rate over the past few years. So with all that said, what am I going to do with my investment in Keppel DC REIT? Well, last I checked, Keppel DC REIT comprises about 10% of my investment portfolio. Actually, with recent run-up in price, this allocation might be more than 10% now. My average cost for each unit of Keppel DC REIT is also at $2.25. I know it's not the best price, and I blame entirely on my inexperience when I invested in Keppel DC REIT back in 2021. So despite my concerns with the REIT, I don't think I've reached a point where we liquidate it at a loss. Also, with a conservative full-year DPU estimate of 9 cents for 2024, this translates to a yield of 4% based on my average cost price per unit, which is not the best, but not the worst either. Nonetheless, should the price vary to about $2.35, I will be liquidating my entire position. At this price, it's close to a 5-year price-to-book ratio of 1.7 times based on Keppel DC REIT's current NAV of $1.37. Now this full liquidation will be due to my previously highlighted concerns and also my desire to revamp my investment portfolio. Now, with regards to rationale of revamping my investment portfolio, I think I'll save that for a future video.